So in today's episode, we're going to be taking a look at the AT&T deal, which consists of a spin-off with Warner Media. And so we'll be taking a look at some of the historical events that led to AT&T performing really badly over the past 4 years or so, and then seeing what potential we have for AT&T going forwards. And so for those unaware, back in 2016 we had AT&T that was in advanced talks to acquire Time Warner. Those talks led to an acquisition of Time Warner for $85 billion. Now at the time this was a really high price to pay. Many people, including shareholders, were unhappy with the deal that was taking place. And so in 2017, the Time Warner shareholders approved the merger with AT&T. And during that process, AT&T has struggled with the delayed rollout of 5G. And then for the several years leading up to present day, we had Warner Media, which revealed their streaming service known as HBO Max. This is one of the better moments within the merger. And given that they signed big names such as J.J. Abrams, this demonstrated that AT&T was committed to putting money into the streaming side of the business. Now the main issue though is that you've got AT&T, which is traditionally focusing on the likes of 5G. You can see some of the overlaps as to why they're looking for a streaming based service. But at the same time, if you look at the likes of Netflix, they're a company that solely focuses on streaming. And the issue with AT&T is just the lack of focus that they've had over the years. And that has resulted in a poorly valued stock over the last 5 or so years. And so fast forwarding, we now have AT&T, which has spun off from the Warner Media unit. And so there's 2 stocks that are available. We still have AT&T and then a new company formed, which is known as Warner Bros. Discovery, or WBD. Now for anyone that owned AT&T before the merger, within their portfolio they would have seen some new shares for WBD. As shown on my Trading 2-on-2 portfolio, we can see that there is no percentage increase or decrease, but these stocks have been added into my portfolio. There's 19.5 shares that I have in WBD, and that's because I currently own 81.9 shares in AT&T. Now if we ignore the high price that AT&T initially paid for the merger, I would argue that the concept of bringing in a service platform wasn't technically a bad idea. If you look at the likes of Disney, their company is spread in all different directions. You've got the theme park area, you've got their entertainment section, and then more recently we have Disney Plus. So for companies that are able to segment their teams and really get the best out of them, then acquisitions can work well. Another great example is that of Alphabet, which now consists of the likes of Google and then all the other divisions as well. But for AT&T, it's evident that if we look at their fiber optics and their delay to 5G, that really impacted the heart of the company. And so a lot of shareholders are hoping that now that they no longer have to focus on the streaming service platform, they can go back and they can start focusing solely on the digital space such as 5G. Now for shareholders, it's actually great that we have this separation. When companies don't perform well under initial merger, we now have the ability to invest into, say, AT&T or into the Warner Bros. Discovery stock, and depending on what we prefer, we can have exposure. And so it's actually important to look at both of the stocks, trying to understand if both of them can improve in the future. And so first up, let's take a look at AT&T. Now we do need to wait until April 21st before the company releases their 2022 financial report. And so all we have to go by at the moment is how AT&T was performing prior to the spin-off. With the spin-off complete, there's around 40 billion or so that is being paid back to AT&T. That's half of what the company initially paid. The truth is we just don't have enough information to see what AT&T will do in the future, but the company was still profitable, and now that they're no longer focusing on the streaming service, hopefully things will be better from here. One of the key points to make is that due to all the issues that they've had over the last 4 years, this stock is actually undersold right now. Dividend yield is currently 5.68%, but traditionally AT&T is a value-based stock. Hopefully the price can start hitting around 25, ideally higher in the future, but there's room for growth in the stock price given how undersold it is right now. And since the merger with Discovery, we've got 2 different platforms that coexist at the moment. We've got Discovery Plus and then HBO Max. Eventually, they will be combined into a single platform with more content and with more users. The ratio at the moment is that at the end of 2021, HBO Max had 74 million streaming subscribers and Discovery Plus had an additional 22 million streaming subscribers. Now, you may be thinking that, well, if AT&T is removing some of its old baggage, then does it mean that WBD is a poor investment choice? choice. Well, that's not the case. If we look at the merger initially, the price paid by AT&T was poor. We know that given that they've received around half the initial investment. But by combining Warner Media, which effectively is HBO Max, alongside Discovery, those two streaming platforms make much more logical sense and should be able to fuel the growth and hopefully gain more subscribers. And so if you are looking for a growth stock, WBD does have the room to grow higher numbers, but equally as a dividend investor, owning more of AT&T for its value does make real sense, and hopefully in the future we'll have stability in the dividend yield and an increase in the underlying stock price. And so do comment below what you think about AT&T and their future prospects, and equally if anyone is buying into WBD, do call out in the comments below. Thanks to everyone who subscribes to this channel, and with that said, I'll catch you in the next one.